Okay, thanks very much, everybody, for coming to one of the absolute best panels of the Milken Institute London Summit after the Drought, the Rebirth of European Venture Capital. Even the title allows for a lot of interesting things to unpack right there. Let me, with kind of no further ado, introduce my panelists, and then we will go down the line and they'll give a couple of sentences about what they do. But before, can I just ask, are there any LP investors in the room? Okay, great. Could LP investors at the end kind of stand by the door so that my panelists can find you? And are there venture capital or angel investors in the room as well? Okay, terrific. Okay, great. Okay, so on my far right, I have Hussein Kanji, who's the founder of Hoxton Ventures. To my immediate right is Daniel Keiper-Knorr, who's the general partner and founder of Speedinvest. He'll be speaking a bit more quickly than the rest of the panelists. To my immediate left, I have Farooq Abbasi, who's a partner in Mosaic Ventures. More to the left, Erin Platts, head of commercial banking at the UK branch of Silicon Valley Bank. And to the far left, this is not a political statement, ladies and gentlemen, is Andrew Lloyd, who is a partner in Episode 1 Ventures. So Andrew, Adrian, why don't we start with you, Adrian, and just go down the line and tell us a little bit about your firm and what you guys are up to.
Great. So Episode 1 Ventures was formed in 2013. We just closed our most recent fund, actually announced it last week. So we got about £100 million under management. We invest in companies at the seed stage and take them on a pretty intensive journey through to Series A. So most of the partners and investors in the fund are former operators who have different backgrounds, help the companies in different ways. But we see ourselves as the kind of hands-on investors, helping companies grow from a startup into a beautifully presented company to hand-on to guys like Hoxton and Mosaic, who write bigger checks than us. So we'll invest normally under £1 million to buy 20% of a business, just to give you an idea of the stake and size of check and stage.
Hi, everyone. I'm Erin Platts. I'm the outlier in the group in that we are focused on commercial banking and senior and debt finance as opposed to direct equity investment. But at Silicon Valley Bank, we're exclusively focused on innovation, so working with everything from super early stage startups through to public and private corporates. We've got about a 55% market share of all venture-backed tech companies in the US, so pretty large. The other pillar of our business is working with banking, lending to the venture capital and private equity funds themselves. So we very much have a footprint in both camps, and with that are able to grow with our companies, have a pretty good network that we like to leverage to make our companies more successful. And then on the debt side, we start everything from $1 million through to about 50 or 60 million, and again, senior, junior, everything pre and post IPO.
Yep. Thank you for having me, everyone. I'm Farooq. I'm with Mosaic Ventures. We're a $160 million venture fund in London. We invest all across Europe, Israel, and selectively in the US. What probably differentiates us is we partner with LPs that are all American to at a very long-term focus and oriented, so nonprofits, endowments, which gives us sort of the opportunity to invest in our entrepreneurs and really support them to a long outcome whenever they're ready for their exit. The fund was started in 2014. We do kind of classic Series A investing, so kind of average check size about $4 million. And we often syndicate with US leads and co-leads. Yeah, that's us.
And both of you have some government money. Are you impact investors in any way in particular?
So actually, no government money for us specifically. Yeah, but I like to think that all of our companies have an impact, but not necessarily in the way that you're describing.
Okay.
And we have the British Business Bank. It backed both our funds. So in the first fund, they were 2/3 of the money. In this fund, they were 60% of the money. So they're slowly weaning themselves off us, or rather the other way around. They want us to find some institutions to replace them in the next fund, probably.
But
there's no impact agenda. It's all about helping new managers form to grow the tech sector in the UK and create jobs. So we've grown our companies from 100 people as employees in Fund 1, and now they're collectively about 1,000 employees. So we've hit that metric. I'll be telling them on Thursday when they meet us again.
Okay, that's fantastic.
Yeah, good morning. I'm Daniel. I represent Speedinvest out of Vienna. We are a pre-seed, seed, and early stage venture fund started in 2011 managing 120 million euros, so practically very much the same as Adrian is doing. Pre-seed, seed, and early stage young entrepreneurs focusing on tech startups from Europe. We are invested in 17 countries across the continent, stretching from Spain to Estonia and from the UK to Israel. Topics, fintech, consumer marketplaces, and core technologies.
Okay.
And Hussein, I run an early stage venture capital fund here in London that invests across Europe. We try and find companies in Europe that we think are going to form brand new industry categories or product markets, and then try and back them from the very early days, either seed or Series A. Our first fund has about 3.7 billion in market cap. We're a $40 million fund. It's not that hard to find these great categories in Europe and invest in them.
Okay, let me start with you then and ask a question. And I'll have anybody that kind of wants to jump in on these questions, do feel free to. But let's talk about the difference in the European, I mean, is that even the right word to use? You're Vienna-based, and we've got UK, Israel. What is the difference in the European VC market versus Asia versus Silicon Valley? Should we think about it differently in terms of either the kinds of investors? You hear sort of US investors are growth first, European investors might be a bit more profit first in their mindset. Is there a difference in terms of the kinds of management mentality or how the management teams are? Is there a certain kind of company maybe that a European market, VC market is more appropriate for? How can we kind of unpack this ecosystem a little bit?
So if you rewind history, you would have said that there was a difference between European entrepreneurs and American entrepreneurs. Historically, the difference was European entrepreneurs didn't focus as much on the ambition. That changed about 10 years ago, mostly because of social media. Information just became much more global, and your peer set wasn't the local peer set anymore, it was a global peer set. And so if you know your counterpart in California could produce $1 billion company, you also wanted to produce $1 billion company. So that changed. The investor mindset, though, is probably what you said, which is much more profit-driven. I think in general, Europe has taken an attitude for loss aversion versus wealth creation, whereas both American and Chinese investors have been very focused on wealth creation over losses. Losses come as part of the territory, and I think it's very common in Europe to try and avoid losing money, even if it means you're not going to be able to make that much money. Whereas in California, you realize this is an outlier-driven industry. There are a handful of companies that generate all the returns. You want to be in those companies, even if it means you do 20 investments that are duds, but the one turns out to be a $500 billion company that more than compensates you for the risk that you're taking. That hasn't happened, and that's not intuitively obvious to most European investors.
And is that a cultural thing, or is that kind of the institutions are different?
So generationally, again, if you look at just the UK, the first wave of investors here were chartered accountants. And while accountants are great, they're not necessarily the most risk-taking individuals in the world. The second generation was bankers. And again, while bankers are great, they're much more P&L and balance sheet focused. And it's this third generation that are folks who've actually built their business or built businesses from the trenches. Those are the folks who usually are the most likely to take the bigger bets.
So Daniel, what do you say about this ecosystem? Because I mean, I've heard that sort of the Germanic kind of area of Europe is the best place maybe to start a company, but that the funding ecosystem for later stages is just not there. And so sort of pros and cons to...
Well, first, I can completely second what you just said.
This is not a recipe for an exciting panel.
I know,
Agreement.
but
I'll stir the pot, don't worry.
Okay, great.
probably me coming from German-speaking Europe, that general perception of the risk and reward lifetime value creation thing is totally different in our region. We have fantastic engineering talent, and it is my strong belief that the European engineers, they top the Americans easily. If you just take probably out the top of the pyramid, probably Stanford and the other good schools, but the general broad, the European engineers, and this was my personal experience with my former company that I had, they were, say, better, if not far better than their American peers. So engineering talent is there, but that whole entrepreneurial, risk-taking, and the ambition thing, we lack completely. And this spreads into those people that give the capital to those companies. They expect sooner returns. They are maybe happy with smaller returns if they are more secure. But we see this changing. We do see this changing. We source a lot of companies from Eastern Europe facing down to the Black Sea. There, of course, they have been under communist rule for 50 years. These are 2 lost generations. We just see this growing up. Now, the young generations, the 20-year-olds, they are completely European, if not American mindset. So they didn't even bother to look at Europe. They directly go to the US. And so this was one of our hopes when we started our fund, that we pick those good people there, move them over, and eventually move them further over to the US. But does not so easily work because they directly go to San Francisco.
Right.
So they just wave down from the plane.
I see.
So we see a shift in
And Farooq,
mindset.
is this why you target American investors, or?
Well, I mean, basically, when we raised the fund in 2014, I spoke to a whole group of people and individuals, and I think we chose our limited partners based on their kind of experience in the asset class, their long-term oriented approach, and they would back us for kind of, hopefully, many funds in the future, and realize that building a new fund is like building a startup. It actually does take time to sort of build a brand and kind of build out a team and ensure the right startups find you and you find them. I guess to sort of second what Hussein mentioned, I mean, the other couple things that I think have been kind of tectonic shifts is just around acquisition channels online. I know it sounds basic, but distributions of app stores, for example, distribution of platform companies like Salesforce, App Exchange, and such others has enabled European entrepreneurs who haven't necessarily been able to sort of fund expensive sort of boots in the ground sales forces to actually sell their products very quickly. I mean, this is one of the reasons why Sweden, such a small country, has produced so many unicorns and have actually built category-leading companies and businesses.
Payments.
Payments, design-oriented, gaming. I mean, that's just one example. And there are a couple other categories I'd argue in Europe where you can find entrepreneurs, and there's sort of an alumni talent, but also engineering talent to sort of build what is the best of Europe. So you have to, similar to Hussein, I think, what are there sort of markets and products that should exist, industries that should exist, and why does it make sense mostly for it to exist in Europe? And I think in the Nordics, I just described a few. Fintech for sure. I think in London, kind of core artificial intelligence and applied artificial intelligence, good schools, and actually schools that have less of a corporate influence. I'd actually argue in the U.S., NYU has a great computer vision program, and Jan LeCun is a genius and one of the best people, but he's very kind of in the Facebook world. I mean, half of his salary is paid by Facebook, and a lot of the engineers go there. Carnegie Mellon, that's kind of Uber. And it's funny about the Europeans is that they just want to focus and work on sort of hard problems. So you tend to find a lot of great talent here, but there are some knocks still, and I think the knock would be, I think the alumni networks need to sort of develop a lot more. I think actually a lot of the options, and actually for employees, I don't think actually historically a lot of the employees in Europe actually have enough of the companies, and so it's sort of shared up top. And I think that's sort of, particularly in Germany, I'd argue, there's a lot of sort of cash-based compensation, and I'm really glad actually Index Ventures, one of our good friends, they published a report recently in a kind of a tool set just to sort of make your option plans and your sort of stock work well for everyone.
Okay, and I do want to drill down on kind of the future, but let's, Erin, you're pretty well placed, I think, to do the comparison actually between the U.S. and Europe, given Silicon Valley Bank. So what do you think about this?
Yeah, I've been here now for 10 years. I came over in 2007, and as the guys were saying, the difference between what's happening then versus now is night and day. And I think many of the differences to me are still about an ecosystem maturing, right? So whether it be founder liquidity or how do you incentivize staff, a lot of it is just we need a couple of iterations, but it's growing exponentially in the right way. I think again there's still some things that are very different and make it harder for UK European businesses to scale, particularly in the enterprise space. So corporates here are just not as early stage founder friendly, not as willing to take earlier stage risk in terms of product. So, but I think it's, from my perspective, hugely bullish around what's going on here. And I think it's just a matter of maturing, though there's a few things that we need to focus on.
So Adrian, let me let you respond to that, but then also kind of tee you up for the next question as well, which is a more of a forward-looking question. You know, what is the potential for the European VC market? You know, what can it truly rival Silicon Valley and China? And is it just a matter of growing up, as Erin said, or are there things that need to be done in the regulatory environment or the more broad ecosystem to make that happen?
Okay. A dozen questions. I'll start with.
Yep.
So I think there are two important things to address from the first question. One is the way I look at the world is when we're investing is, are you talking about enterprise companies or consumer companies? And I think they're very different beasts. They need to be funded differently. They have very different routes to market. They have different ways of monetizing, et cetera, and very different exit profiles. So a massive, and there's also I kind of disagree that the cultural difference is not so great as it used to be. I think the gulf in the confidence of entrepreneurs is still there between the US and Europe. I only invest in the UK, so I know the UK better than the continent.
Talk about that a little bit, actually.
So, I mean, it's kind of a fun anecdote, but I think it's meaningful. Is in a study I just read about recently around mathematics and the confidence and ability in mathematics amongst high school students. So of 8 countries, the US was actually the worst of the 8 in terms of ability, but the students felt they were the best. And the Koreans were the best, but they felt they were the worst. And you know, there were European countries in between. But the ability to have the confidence in what you're doing and have that kind of mentality drilled into you from high school, arguably in this study, is hugely important. It comes to roost on a unfortunately regular basis with companies in the UK, where you have an entrepreneur who's got a fantastic, superior product, a lot of fantastic engineers doing something incredible, with a CEO who's probably technical. And in our own portfolio, this happened last year, and a kind of upstart from the US that was kind of much less formed, very similar product, very similar market, and our guy who'd been a CEO for 20 years, really experienced, knew what he was doing, but just is the worst salesperson in the world. Charming, hires really well, but in front of investors, not great. You know, he raised a £2 million round, while this guy who had a company that just started raised a $20 million round. So very different dynamics. They were selling into the US exclusively. We just started, but it reminded me of the difference and the importance of the ability to sell.
Yeah, you need a little of both for sure.
Yeah, and then to your second question of the future for Europe, I think it's super helpful to have centers where a lot of activity happens. So in the US, it's Silicon Valley and New York principally. In Europe, it is still, UK is the first, but there are other big centers in Europe. Paris has obviously been in the news a lot recently. The new president is putting a lot of effort into increasing their position in that world. Germany has its centers. The Nordics have their centers. It is spread out, and I think that is problematic for creating a real rival to Silicon Valley, because there are all those benefits of being in one place, and that we can't fix. There are benefits from it as well, but I think to imagine we could create a Silicon Valley here is probably unlikely, because that's one place where so much is concentrated. We don't have to, of course.
Would we really have to create a rival to the Valley?
No, but that was the question. So we don't have to. Big companies can still be formed, but the weight of money is still in the US. So you might have a really ambitious founder, but can they exit because the public markets aren't really operating well in that regard, and the number of listed companies has dropped in half since the mid-'80s. So the public markets are a pretty unpleasant place to be. All the reporting requirements, it's difficult, so people stay private for a long, long time. And that will create challenges for investors, particularly early stage, but actually maybe even worse, later stage, where there isn't an investor after them to take their stake.
Yeah.
I think that exit dynamic is kind of global at the moment, right? In terms of there's so many companies staying private, valuations are super high, and the only thing they can do is really go public, or their potential exit avenues are tiny, just given valuations. That's not just a UK European
Absolutely right.
issue.
Any other kind of predictions on the future of Europe, and does it need to be Silicon Valley? Or I just want to make sure everybody has a chance to weigh in if you feel, is there anything in the regulatory space that needs to happen or that is happening? I mean, UK is a bit famous for the sort of the fintech regulatory sandbox, so they're getting a lot of attention in that particular sector. Anything else that could be done or is happening that we should know about?
So, I mean, the one observation, this might be slightly controversial, is the biggest investor into European venture funds is the government in one form or another. I'm not so sure this is actually a good thing. So the EIF, which is the European Investment Fund, which up until very recently was also investing in the UK,
As 12% of the funding market.
I actually think it's higher.
Oh,
They,
is it?
they don't
That might be,
report it,
yeah.
but I think I think it's as high as like about a third of the overall market.
Oh, okay.
So they publish their in returns since inception, since they started doing venture investing, and unrealized plus realized returns. Their average performance is 1.09x. So if you gave them €1, I think it was about 17 years ago, they'd give you €1 and 9 euro cents back. Their top quartile was 1.71x. So then just by math, like simple algebra, that means the bottom half is losing money. Because they're so powerful, they are the dominant engine behind the venture funds, you have a non-market economy now that's allocating capital. And when you lose money institutionally, you train yourself from preventing other people from losing money. So the entire organization is designed not around wealth creation, but against loss aversion. So they invest in managers, and they don't allow the managers to bet big because they're very afraid that the bulk of their managers, which is historically the numbers I just gave, lose money. When you have a non-market actor like this, I think it screws up the economy. I think I'd much rather see the government give this money to like 20 different EIFs and have them compete against each other to find the best managers versus concentrated in one institution. And sadly, the UK is following exactly the same suit with the British Business Bank, which just got £400 million this year to deploy. I'm not so sure this is actually going to yield all that much in the way of taxpayer returns.
Question, where I really like to hear what you're thinking. You said the EIF invests across the continent. Almost every VC has the EIF on board, and it returned €1, 9% on a euro.
After
Doesn't
a lot of
that
years.
mean that the whole industry doesn't work? Like when you have every fund in there,
Yeah.
and that just returns 9 cents on the euro, that means that the whole
It's kind of an
industry
index.
doesn't work.
But an index of venture never works, right? If you look at even in the US, average returns are very misleading in our industry because it's usually the top 25%, top quartile, and it's usually not even the top quartile, it's the top 5% or the top 10% that generate almost all the economic returns in our industry. So averages are kind of deceptive. What I just worry about is these institutions are the backstop for the industry because the market failed for the last 20 years. So the government had to step in. The problem is now you've concentrated so much power in these institutions that they're non-market actors, and they have trained themselves on how to prevent people from losing money. So when people actually come to them with a formula for making money, they put the same handicap restrictions on the 50% that lose money on the 1 or 2% or 5% that actually generate money. I'm not so sure this is actually productive for the economy.
Adrian, are you feeling
Can I-
handicapped?
No, not at all. So I'll stand up for the British Business Bank, which has a different approach to the EIF. So when you get money from the EIF, which we didn't apply for, although we started our fundraising before Brexit, 'cause we were a little worried about what might happen. Once they're in, they stay in forever. So you get them into fund, whatever number it is, 2, they'll be in from 3, 4, 5, 6. They don't go away, which I think creates these problems, and I agree with Hussein that is problematic, particularly if they don't insist that they're a very small percentage of subsequent funds. With the British Business Bank, it's quite almost explicit, although because they're bureaucrats, they never quite tell you an answer.
And also because they're British, they never quite tell you.
Well, quite. They don't want to upset you. They're very polite about it. They say, fine, Fund 1 will help a new manager get off the ground because it's going to be hard to raise a £40 million fund that can sustain 3 partners and a company, etc. So Fund 1, fine. Fund 2, if you're performing well, and you have to be performing well, you'll get support, but as a smaller percentage of your total. Fund 3, they're basically out. There are other funds within the British Business Bank, for example, the Catalyst Fund, which will give you a £10 million check, right? But nothing really meaningful. At that point, you have to be able to get proper institutional backers, whether it's a fund of fund or a pension fund or someone else.
So
or
the
something.
Catalyst rules just changed post-Brexit or post the EIF pulling out. The Catalyst Fund is now able to do 50% of a fund, and the Catalyst will stay with you forever.
So I don't know how that interlinks with the Enterprise Capital Fund or the size. It's certainly not our intention and not what the British Business Bank has said to us about this fund. And you may be right, and I wouldn't think that. I don't think that's a good move by the
So
British
I'll give you
banks. I agree.
a good form of regulation that the UK did was they incentivized angel investors to invest into companies by giving them a tax credit. And as a result, they took a lot of high-income earners in the UK that would ordinarily just give the money over to the tax authorities, to HMRC, and incentivized them to actually put it into companies. And the amount of angel funding blossomed. But that was a market-oriented response to a problem in the market. The institutional response is the big checks have been concentrated in very, very, very few players. I'm not so sure that's productive.
I think going forward, I think it's a really valid point. And how do you want to continue to support what is a maturing ecosystem? But if I reflect back in the last 10 years, I'm not sure we'd be where we are in the UK and Europe without EIF. I'd be surprised if we had the same level of maturity and capital available. So going forward, definitely, I think we need to look at how do you reduce the amount of reliance on government funds. But I think net, I think it was a huge positive for our ecosystem. I think that EIS and SEIS, again, unbelievable move, but double-edged sword, right? Because not all of a sudden you have these individual investors that are only investing in innovation because of tax incentives, or they're kicking up valuations and creating problems for their companies. Again, net, hugely positive, but all of these things have positive and negatives that you need to work through.
Let me just ask you a quick question, though, on the banking sector. Are you finding the same thing with respect to lenders, that you're a bit more aggressive and there were sort of easy pickings because the banks were too cautious in the VC, in sort of early stage space, or was it hard to break in?
Yeah, so when we got here, 2006, 2007, and then financial crisis 2008, it was weirdly great timing for us, right? Because every single bank was retracting, and we were able to make a name for ourselves and be that consistent player. I think competition has changed hugely in terms of banking and lending, and that's not a bad thing, right? I think as companies break through and as there's more capital available for entrepreneurs is usually a better thing, usually. So yeah, the competitive landscape has changed dramatically, but we had a really, really warm welcome into the UK, and as we look to expand across Europe, hopefully that will be the same.
Okay, let me throw out a statement about the global VC industry that, and the data is kind of mixed on this, but since 2014, in 2014 there were about 19,000 rounds, and last year there were about 10,000 rounds. So almost half of the VC rounds, most of the drop in the early stage rounds. The total funds allocated, though, haven't dropped that much. So this is kind of the implication of that is it's a winner-take-all story increasingly. Is that the way you see it? Is it, and then also talk to me about froth. Is there froth in a couple of names, and other companies are still struggling for financing, or is that just wrong?
So the data in Europe is a little bit different. So if you go back 5 years to 2012 and you look at the volume of deals that are done, so rounds that are done, it's depending on the stage of the company, it's either quadruple or quintupled, which is a massive increase, right? But remember, we came from a very, very low bar, so we're now a much more competitive bar. The bigger problem in Europe these days isn't number of rounds, it's number of scaling rounds. So it's actually reasonably easy these days in Europe to raise $5, maybe even $10 million, but trying to get $20, $30, $40 million to step on the gas before you've very clearly defined the formula for success, so you're still a venture deal versus a growth deal, those rounds are incredibly difficult, and the growth there hasn't happened, and something like 60% of those rounds are being done by Americans.
And I think there's quite a maybe overly simplistic reason for that is if you look at the US, it's a market of 400 million people. If you look at Europe, it's a market of 400 million people. But the culture is the same, the language is the same, and therefore the investor's ability to see into the future of the trajectory of growth, particularly if it's a consumer business where language is obviously a much bigger issue than an enterprise business, it makes it a lot easier for investors to invest in those larger scaling rounds in US businesses than the UK or in individual countries in Europe. Because scaling across US states is difficult. I mean, it's not actually that straightforward, having been through it a few times in the last 4 years, but it's a lot easier than scaling across countries.
Yeah.
But that's all the more reason why you need capital in Europe at those stages, because otherwise you can't actually scale up.
Absolutely. But if you're an investor looking at it, it's like, this is going to be really tough. I've got this much money. I just put it into a US business, which, you know, is overly simplistic, and there are going to be some great successes in Europe.
So it
don't doubt
encourages a kind of winner-take-all type of investing strategy. Is that what you're saying?
I'm saying it's harder to make the decision to invest if you're looking at two companies which have a similar makeup, say market, great technology, whatever, US, Europe. It's easier to see the US company growing fast.
Okay, what about froth? Daniel, Farooq?
So, please.
Good question. In some areas, probably. But coming back to your initial statement on the number of rounds and amount of money deployed, rounds down, money the same. We saw this too, like valuations have gone significantly up in that space where we invest in. So in our first fund, vintage 2011, we have an average entry valuation of 1.9 million euro. And in fund number 2, that has gone up to 3.5, 4-ish.
Interesting.
So companies asking for high valuation, they're getting paid those valuations. That is like, you know, in some areas there might be a publish hype to it. You know, some topics like around fintech or those high scaling consumer facing businesses, especially out of also Germany. But for the really tech projects, we don't see this. So there is still enough projects coming in. So deal flow has not slowed down, totally not. I don't know what you guys' experience is, but deal flow is like
Yeah, Farooq.
growing still.
2014 was definitely the frothiest in sort of recent history. And actually, unlike in the United States, and you've probably seen Fred Wilson blog about this and a few others, that there's been an implosion in early stage funding. Hussein is right that the decline has actually been much more measured in Europe. I think it's only gone around, I think it's expected on the run rate basis, 2017 for venture funding to go down maybe 6%. So I mean, I'm more encouraged that sort of Europe is sort of bolstered, and there's still a lot of capital in the market. Totally, I mean, so on the notion of sort of the, you know, returning 9 cents on the dollar, or actually $1.09 on 1 euro, it's tough because actually on the ownership side, you do need more ownership. I mean, if you can't get into the best companies, or if there's not enough good companies, you need to sort of be compensated for your ability to get 15, 20 points. And I actually would argue that's also a challenge for early stage entrepreneurs, where they get diluted too much at the early stages, and because of the lack of the exit environment in Europe today, you just don't have the ability for entrepreneurs to actually raise that scale up capital, and cap tables are just so sided on the form of the entrepreneurs, and that's just a tough kind of system and sort of feedback loop to live in. On the growth side, though, anecdotally, all of my friends in growth in Europe they're all going earlier, and actually like the growth did peak quite a lot in sort of 16, but actually 17 looks a lot more modest, particularly if you reduce the outliers from SoftBank and Improbable, et cetera. And they're actually going earlier. And so I think that it all kind of goes down to the M&A environment and the exit environment. And if that doesn't exist here, that's like really the kind of sore piece in the puzzle.
And we've just seen this recently with the large corporations outside the tech scene are starting to buying startups.
Yeah.
Yeah, especially when I'm only speaking for the German-speaking Europe, but that has just practically started 17, that like companies like BMW and Mercedes are tapping into that automotive, transportation, Uber business. They totally did not recognize that scene at all.
If you can't beat them, join them.
Might be. There's a massive shift in boardrooms towards from own creation towards outside sourced innovation, buying that into the company because it's more market-faced, quicker, cheaper even.
So this is a good segue to ask you about pipeline and sourcing pipeline. But let me just first alert the audience that we will leave some time at the end for questions. So think of some good questions. I really have Europe's top VCs on this panel, so it's a great opportunity for you to ask your own questions. But let's talk about pipeline. How do you all source companies?
Well, something that we're doing more of now because of this whole wave of artificial intelligence, which has clearly hit the market in a big way, and we've invested quite heavily into the space, which, by the way, takes a little longer to get to product market fit, needs a bit more money. So that's a reason that we've been writing bigger checks at the first stage to give the companies long enough to get the data to prove the algorithms work and to sell stuff to their customers. But we're going right back to the computer science departments at the major universities. By the way, half of the top 10 global universities for computer science are in Europe. So, and the others are, of course, there are some US names and some Asian names. We have the most institutions. We have 60,000 people, probably postgrads graduating in STEM subjects compared to 30,000 in the US. There's a lot of really timely intellectual horsepower being created in Europe. So to go back to the question of pipeline, all the normal sources, but we've now spending more time with the academics at the institutions and with the spin-out centers, which we hope will bear fruit. All the companies we've invested in that come from the kind of AI and more deeper tech space most of them have come through a spin-out department or organization of some sort or another. And so we're trying to kind of go a little earlier and tap into that.
You get them as an undergrad, you tell them to take a few communications classes and sales classes while they're there. So
Usually post-grad and go to a Stanford course on communication, and then you'll be set.
Okay. Anybody else want to talk about deal flow, how you source?
Well, we see network effects, actually, coming from the existing portfolio. They have their own networks among the engineering classes. They recommend funds crosswise. What we recently also did is that we opened an office in Moscow to even further go east and source that talent from there. Amazing, really, really amazing technical talent. Like Russia produces 45,000 engineering masters every year. The same size as the US.
Yeah. I remember talking to a venture capitalist in the 90s. I mean, I was just a child, obviously, but who was investing in Poland. And I said, this is 93. And I said, isn't it hard investing in Poland? He said, yes, it is hard. But if you go up to an average 40-year-old male on the street, chances are he can take an integral.
Totally.
Yeah. And it's worth it for the technical talent.
Yeah. So for us on Pipeline, we try our best to be as thematic as possible and invest with a prepared mind, and so go deep in a certain market, whether it's something as specific as computer vision and artificially intelligent assisted driving, or cybersecurity, or temporary work, and how the gig economy is changing things. You still have to be kind of opportunistic and network driven. I think the good thing about venture, if you really think about it, is it's just a system of relationships that you build and goodwill you build within each other. It's sort of like a family, if I'm going to kind of romanticize it a bit. And if you
Dysfunctional at times.
for sure, particularly in partnerships, they can be.
Should we all hold hands?
No, but so first, there's a huge ecosystem of angels, and not just in the UK, but all over, who are technical and entrepreneurs, and they exit their companies, and they actually want to sort of invest in their friends and their alumni. And I think that's where we've seen a lot of deal flow for sure. Certainly within our own kind of portfolio, founders that we find, and also we've done kind of a good job nurturing CISOs, CTOs, and C-level execs at large corporations at Mosaic. And the good thing about that is that we get kind of a pulse and better understanding of the kind of problems that they're having and what they're really most worried about, and not getting too sort of in the clouds thinking 25 years ahead or 30 years ahead, but like what is the problem they need to solve and address, and just sort of being kind of methodical and ask them just sort of questions about their issues and just try to help them in sort of that kind of goodwill cycle. So I mean, it's certainly a mix of things, and I think the thing that we're doing last, which is a bit newer, is, like I had mentioned before, I mean, Mosaic, it's our first fund. We are also a startup, and we're trying to use technology and data to make ourselves more efficient. So you have PitchBook, Mattermark, lots of other sources online, LinkedIn, and there are ways to sort of never actually outsource a decision, but to actually sort of pre-qualify things, because it is a big world. I mean, in Europe, I guess we have 50% in seed and sort of angel investments. We're at 50% of the number in the United States and 30 to 40% of the volume. And for a team of 6, covering that geography is tough, and we need to sort of be efficient ourselves. And so really kind of being data-driven in our approach and how we sort of unearth companies is becoming an increasing competitive advantage for us.
Erin, do you kind of piggyback on the VCs for direct lending to companies, or how do you think about your lending pipeline, your credit pipeline?
Yeah, definitely, especially at the earlier stages, right? When companies are fast growth, loss making, we want to be partnering with these guys and supplementing their rounds with scalable debt. I mean, it's also important that we're proactively reaching out and finding opportunities, both in terms of direct lending and supporting companies, but also hopefully providing deal flow to our partners, right? So a lot of venture capital and private equity funds are our clients. And so if we can go out and use our network, 160 people here in the UK, to find interesting businesses and show them to our fund as partners, it builds some goodwill as well. So, yeah.
Do you all take cold calls? Does anybody take cold calls? Yeah.
Yeah.
Yep.
Yeah.
Our entire business is optionality, right? There's no harm in taking a meeting of some kind. It may only be 10 minutes,
Sure.
but there's no harm. But my simple strategy is I just see who adds Farooq to LinkedIn and then call them up.
There is this rule of thumb that one investment pays back, like 10% of the investment pay back the whole fund. It's like a percent of what you see is actually investable. So 99% of the meetings or the calls end up in no deal. So there is tons of kilometers in vain.
Actually, the last thing I'd highlight, though, I mean, I'm sure everyone on the stage would agree, but it's better to invest in lines instead of dots. So you actually want to get to know an entrepreneur and get to know the founders of a business. I mean, much earlier on in their career, I mean, I think I'm very encouraged by it. There's a ton more capital in Europe for founders to choose from. And I'm actually happy to say choose from because they have more options now. And I think actually US options are much more available. And so I think the way to sort of find those companies and sort of nurture goodwill with people who are going to be part of the extended family, to go to my weird metaphor, you need to sort of just get there earlier and be helpful earlier on, at times even when Adrian's investing and Hussein's investing and everyone else.
Right. Okay, let's unpack that a little bit, that sort of notion of being helpful. So what exactly, besides the fact that you write a check, what is the value add that you provide to companies? And try to stay, away from the banalities. Like, what are you actually doing to help your portfolio companies? And how do you think about that? Anybody that wants to?
Sure.
And also, maybe I'll add to that, how do you source talent, by which I mean investing talent?
Yep. I'm happy to take a stab at it first.
Okay.
So I actually think at a minimum, you have to just not get in the way. So what I tend to see in sort of venture financings in each round, there's usually one or two kind of people who have sort of the founder's sort of ear and earshot to just sort of be a shepherd of the entrepreneur. I mean, like you really are on the same team, and I think the key thing is to try to identify what are the sort of the 3 or 4 big pieces that they need to accomplish in order to sort of raise more money to prove out further hypotheses, and you kind of pass off the torch. I mean, you can stay on boards for multiple rounds, et cetera, but I think as long as you do the sort of 3 or 4 things that you sort of promise when you sort of give the money, I think that's key. I would say talent in the early stage, I mean, you just described, is hugely impactful, and a couple of customer introductions. So particularly in the stage where we invest at Series A, they might have an enterprise where I specifically focus. They might just have a couple of POCs and a few enterprise customers, and if you get them sort of like a really talented kind of channel sales manager or a VP of sales who's sort of seen the scale up of a company, and then you also introduce them to 3 or 4 customers, and then when they've spent sort of the Series A money, introduce them to the right couple of people and actually direct them and guide them, you just save so much more time, and time for an entrepreneur is sort of golden. So that's in terms of sort of value add, but I would just really highlight again the kind of not getting in the way. I don't think it's necessary to get on weekly calls or monthly calls or asking them for some odd, KPI metric sheet. I mean, know what you need to ask for, but just be very methodical and thoughtful about the time that you use of others.
That's because we've set them up for you.
Yeah,
My job's easier. because we get in really early when the companies are basically just formed. We have a program we call Innovation to Operations. It comes in 2 parts. The first thing's like something we call internally Startup in a Box, and we send people who are paid by us. We've got 2 of them, and we're looking for the 3rd, to actually just help the founder set up all the important stuff you need to set up to be a proper business.
Go on site and...
Yeah, absolutely. On site, the one person spends 2-3 days explaining how financial models work, how your reporting has to be. A lot of the time, they don't understand the difference between bookings, cash, and P&L. And all that stuff is important to educate often quite technical founders on the basics of running a business. So we want them to run it. We don't want to get in the way. We just want to kind of start them off in the right way. And we enjoy doing that. It's kind of fun. It's like we're going back to the startups that we used to run and doing it again. But it's kind of fairly boring but important technical stuff.
Yep.
And then on the other side, there's a whole series of experts in the market in various different categories, from go-to-market to building a vision mission type thing, to best HR practices, to positioning and creating a category and whatever that means. And on a monthly basis, we have just a workshop that's available to anyone in the portfolio, plus invited outside guests, like people in the pipeline, say, where they can just get 3 hours, 4 hours of really interesting education, a bit like going to a lecture at university. And then if they want to strike a relationship up with that person on a paying basis, then they do that. We just provide the service provider with a bunch of potential clients, and the potential clients are portfolio companies plus others, with someone who's smart, who's done it before, can really help. So we're a little bit more hands-on, and then hopefully they're ready for Mosaic's
Daniel, you
challenge.
look like you're...
No, the same here. Practically it comes down to be the wingman to the founder. Like whatever he needs, sounding board for new ideas, making introductions, taking care of what is not part of his daily business. Or hers, of course. Still way too little female founders we have, but those that we see, they are extremely good. And what to us is daily business is to them probably a once in a lifetime entrepreneurial experience, especially raising next round. So this is, we take actually responsibility for this. Doesn't mean we pay the round, but we make sure it happens.
Oh, really? Oh, that's very interesting.
Yeah.
So let me give a slightly contrarian view to add a little bit of debate to this. So I was comparing notes with a big seed fund in the US that started actively investing in the UK, and every single one of their investments failed in the UK. And we were comparing notes, and they said, we spent all this time, all this energy helping these entrepreneurs, doing all this value add stuff, and it doesn't seem to work in the UK. And I think the reason is, I think venture capitalists deceive themselves from thinking they're the ones producing the value add, when really the ecosystem is producing the value add. So in California, you sit down with someone and you say, look, this is how you ought to do X. The chances are that person has gone to like 10 other people and heard from 8 or 9 other people the exact same advice, and you're just kind of reinforcing something that the market's teaching them. In the UK, sadly, they're going to go to 5 people as opposed to 10 people because there are just not as many, and they're going to get very dissenting opinions on the 5. So you're one of 5 voices, and they have no idea which one to actually listen to. And so your advice actually just bleeds out. So this job, I think, in Europe is fundamentally different than in the US. You are ultimately a stock picker in Europe. And I think you have to train yourself to pick companies that are going to succeed with or without you. It's a very different business than it is in the US. And I think you have to then get out of the way, as Farooq said. And what I think you can actually do that's helpful here is provide shortcuts, but you should not be the source of these shortcuts every single time. The truth is, the people you're investing in should be much, much, much brighter than you and much more capable than you. They may be less experienced than you because you've seen more of the movie. So you may be able to fill in some of the movie, but chances are they're going to pick up this stuff at a much faster pace than you anyway. And your shortcuts are only helpful in the early days. So for instance, one of our companies was doing a partnership with Samsung. It turns out the enterprise CTO of Samsung is an old friend of mine from like the 90s. So he ended up on his desk. He gave me a call. I validated it for him, the whole thing. Samsung is a very slow-moving organization. The thing would have probably taken like 9 months. It got done in 2 months because I was on the other side providing this unfair shortcut. But I guarantee you this company would have closed the deal with Samsung if I was not involved. It just would have taken 9 months. That kind of stuff's super helpful, but trying to actively coach people, I think, bleeds out in this market. I think you've got to pick exceptionally good companies that are going to make it, and that's even more so here than in the US.
Okay. Let me just pause to see if there's any questions from the audience before I kind of continue. Yeah.
I've got 2. So firstly, sectors. Can you talk a little bit about sectors, and specifically healthcare, medtech, biotech? Because I get a sense that although it's been a bit of a rising tide, that's one sector that maybe hasn't risen as great as the others. And secondly, exits, because it is all about exits. And as an investor, valuation is great. it's a bit like revenue, but it's ultimately profit and therefore cash and distributions that I'm more interested in.
This is
A little commentary about the exit market and
Yeah.
This is the problem with that opening up for questions. You take all my good next questions. So just to repeat because we are taping this, what kinds of sectors are you interested in, and how do you think about something that Adrian brought up earlier, the problem of exits? Maybe we'll just. Does anybody want to start, Erin?
Sure. So you touched on healthcare and specifically, and we brought on a person to head up healthcare for us about 4 years ago. It's definitely lagging behind, at least what we've seen in terms of tech and IT, but lots of exciting things happening, healthcare IT, drug discovery. So I would say it's still lagging, but some interesting things happening in the UK, but you need to be across Europe as opposed to just UK-centric in terms of what we're looking at. On the tech side, one particular area we're super interested in, A, because we're seeing great companies, but B, as a consumer of technologies ourselves, is RegTech. So anything to do with compliance, helping financial institutions navigate increasing regulatory environment is really exciting and hugely needed in this market. I have, looking at banking UK versus US, it's fairly difficult to navigate at times. So that's a sector we're excited about.
Just actually, I think you asked on the healthcare side, and that was one of your points. So this maybe is slightly controversial. I think there's a massive gap actually for sort of what is true digital health investors and venture in Europe. And so you have kind of biotech people that will invest in a molecule to fix something or sort of a deep therapeutic, and then on the early stage side you'll have. On the general tech side, you'll just have people who are ex-technology entrepreneurs who've had success and building kind of a behavior modification app where that's sort of input information. And I think there's not really like a Venrock that happens to be in Europe yet,
I agree.
Unfortunately. And so it's tough because you'll have like a brilliant doctor technologist who has like a new diagnostic for cancer therapy, or maybe even something a little lighter than that, like a mental health application which uses data really intelligently for earlier intervention. You won't have many people to actually be able to sort of qualify and classify that as a good investment or a bad one, which is a real shame. And so they have to go to less interesting sources of capital and less helpful people. So I mean, I actually think there's a real gap, and I hope that kind of fills up because I would love to co-invest with those kind of folks. And then on other sectors, for sure. I mean, again, where in Europe are they not necessarily? Forget disadvantage. Where they advantage to build sort of a global leader? DOC, you have kind of manufacturing robotics talent for sure, and that's old and like that's sort of world class. And I think applied artificial intelligence for sure in very specific segments, in areas where the incumbents don't have existing kind of clean data set, and you have you're focusing on the right and you have the right kind of go to market. Certainly, property technology and fintech I think is actually huge for Europe. I think there's a regulatory arbitrage here which you don't have in the US, and I'm sure you've read lots of blog posts about sectors of interest, but I think the thing I would just really highlight in Europe is why can we build something better here than anywhere else and actually build a global leader. And I think there's actually there's a few kind of core case examples of that, but that's where we should double down, triple down, quadruple down.
Anybody else on sectors?
I mean, we're a tech fund, not a healthcare fund, although I think there is an intersection between the two. We definitely have a company in that space. I think in general, Europe produces all kinds of stuff. I don't think it's actually sector-driven at all. The examples of really interesting companies these days in a global world there's just so much more scattered, and the question is the team actually able to become number one globally in that category? We have a food delivery company, we have an AI healthcare company, we have a cybersecurity company. All of these look like they're best in class globally relative to all their US kind of counterparts, but it's very scattered, right? And I don't think you could have asked me 5 years ago, what are you going to be investing in? We're like I said, we're stock pickers, right? We're trying to find companies here that are going to become brilliant in category-defining, category-leading companies. You just don't know what they are at inception. If we did, we'd go off and build them.
Okay.
Also, like predicting what sector is going to be the next big thing is totally guesswork in a way. Because looking back 5 years, I mean, my fund has built a fairly large practice in fintech. And when we did our first investment, that term that didn't even exist. It was some banking software stuff thing that eventually turned out as to be a big fintech startup now. Looking forward now, what's with the next sector? Difficult, actually. RegTech, like you said, definitely. I don't see regulation coming down. It's even going to be more. And with all that automation in business processes and that big data thing coming up, and now the infrastructure and the talent is there to make actually use of all that data, evokes RegTech. I've just been part of or listened to the cybersecurity panel an hour ago over there, and they have been circling around that topic.
And by the time the categories start getting named and people start flocking to them, the early bets have been made. And
That
the
is
reason
true.
why the names are existing.
That is
So if you're going to do AI, you should have invested in DeepMind, right? Which is Google's now category. Google spent $600 million, 400 million pounds acquiring that. It's a very young company when they did it, right? But that's kind of what put the sector on the map. And back to exits. I don't think Europe has a problem with exits, right? You build best-in-class, category-defining stuff. People come and line up to come buy these things if the companies are going to be great, or the companies, if they become really big, can scale up and go list anywhere. And usually they end up listing in New York or on the New York Stock Exchange or NASDAQ. The world is just inherently global, right? So the focus should be on building greatness versus trying to optimize in any other way.
That's where the story starts, right?
Okay.
And I think that, of course, right, companies should be bought, not sold. But I think if you look at 2017, the way I'd summarize it is great fundraising in terms of venture capital and private equity funds, great new company creation, really soft exits, and that does have a knock-on effect to kind of everything in terms of fundraising, founder liquidity, recycling of capital. So,
Okay, 4 minutes left, 2 lightning rounds. So Adrian, we'll start with you. What do you most look for in a founder or in a management team, and what is an absolute deal killer for you?
So founder and management team, the CEO you just have to fall in love with. Okay, it's just as simple as that. There has to be no doubt in the champion's mind, who's championing the deal, that the CEO is absolutely exceptional. And the other thing is that the technical talent has to be part of that leadership. So tech can't come second, it has to come kind of equal first. And then the second question,
A deal that you kind of like, but there's a deal breaker in there.
So if the cap table's really complicated and the company's given away too much equity to angels early on, that just creates a mess for the future.
we're all doing
Go
that.
ahead.
I mean, we're a little bit different in that we're debt finance as opposed to equity, but I think you still look for similar things. So for me, it's depth within the management team. So obviously there's got to be a great founder and CEO, but there's got to be depth there. And for me, deal breakers, and it sounds like an obvious one that all companies should know, but really understanding customer acquisition and metrics. It's very surprising how many companies you meet and you peel back some layers and they just don't quite understand how everything fits together.
Yeah. I would say 3 quick things. Operational expertise, technical leadership, and then vision. But honestly, that's an umbrella of grit. Like, I love to meet gritty founders, people who just won't quit and just won't stop, and they'll find a way to make it work. I mean, really, like most challenges in life are challenges of it's mental endurance, particularly like in business. I mean, sometimes that's not the case, but I'm an optimist, and that's what I choose to believe is grit. And usually that comes out in the first 10 minutes when you meet someone.
Deal killer.
Deal killer, a bad management reference. And also, life is too short to work with unethical people or people who have been dishonest. I mean, like, venture capital due diligence is just really just reducing information asymmetry between the founder and the investor. And if there's sort of dishonesty in that process and uncovering it, you just sort of can get a view of understanding of what can happen like later, and just stay away from it.
What we look for is actually a founder that addresses an industry has to have a basic understanding of that industry that he's going to trying to reinvent. So of course he can learn this on his way, but he's got to be a quick learner. But at least he should pick up some basic understanding of that. And on the other end, what we don't like so much are NDAs.
Just killer, deal killer. Oh, man.
Deal killer, probably not always.
No, it's not.
But
I hear you.
it's like it's an expression of a founder having problems sharing his ideas with me, and This is
That's a real-
or her. Yeah,
that's
or
a real
excuse
market
me,
difference.
Of course.
Nice, I like
And that just doesn't work.
Yeah.
It's my job to test his idea or
Right.
her idea.
Yep, yep.
So what we found is that the most exceptional founders are folks who are going to do this regardless of any type of outcome. This is
Amen.
something they're deeply passionate about. It's a problem that they want to solve in the world. And then they tend to attract people who are even stronger than themselves around that mission. So we spend a lot of time looking at the people that they hire more than anything else. And deal break, I don't think there's such a thing as a deal breaker, right? There's so few companies that are going to generate 10,000x type returns. If one walks in the door, I'd rather be a shareholder than not be a shareholder.
Okay, in the last minute, very quick lightning round, A or B. ICOs. They're kind of, everybody's talking about ICOs. Are they the new way to raise equity capital and will revolutionize the industry? Or are they going to end in blood and tears?
.com 2.0.
Okay,
Is B the blood and tears
Yeah,
thing?
B's-
B.
okay,
I love the liquidity, but no, B for sure.
Okay.
Definitely B.
Wouldn't even know how to use the coins. B.
okay. So maybe just to end, if I can just ask anybody that has a piece of advice, either to a SME or an investor that's interested in kind of dipping a toe in this space, just any kind of words of wisdom to end on, and I'll open it up to everybody, not make everybody say something. Adrian.
Diversify a portfolio and almost pretend it's like art. Buy it because you love it. Don't expect to make money from it.
Okay.
For me, the optimist in me says the best is yet to come in terms of UK and European venture and innovation. So I would get in now.
So would I, and just like a stock picker. I mean, pick your managers and pick people you want to work with and be with and have an advantage. People you would actually take money from if you were an entrepreneur.
Okay.
Work with funds, do direct investments later.
Okay.
And take the long view, be patient.
All right, terrific. Please give a hand to my fantastic guy.